Ari Rubenstein joins us this morning to discuss the role that automated trading has played over the past 15 years in advancing secure savings for pension funds. He will touch upon how technological developments and innovations have helped plans save money, as well as look ahead to technology will impact investments in the future. Please welcome Ari Rubenstein.
Good morning, everyone. Thank you for having me at your conference. It's really a pleasure to be here. About a week ago, I was putting my notes together for this conference, thinking about what I wanted to talk about, and I realized I had a really big problem. Your organizations invest for 50-year time horizons. My company, GTS, invests for 50 seconds. And my challenge is to prove to you in the next 20 minutes that we care a lot about the same things, and the information that I have and going to present to you today is certainly impacting your organizations. The other thing I couldn't help but mention is that both my parents were New York City public school teachers. My mother, who lives in the home I grew up in, not too far away from here in Long Island, is retired and living off her pension and my father's pension, who's deceased. And it's those defined benefit plans that are allowing my mother to enjoy her retirement years with her 7 grandchildren who live within 40 miles of her home. And also, when I saw the venue for this event, I couldn't help but mention that of just 3 blocks away from here during the Depression, my grandfather pushed around a hot dog cart to make ends meet. But through the years, my grandfather also saved his money and at times invested his money. He would read the newspaper and took a shot on a few different companies. One of them in particular was Kodak in the early 1950s. And he invested in Kodak, and it was a great investment. He reminded us every Sunday almost of that, how smart he was in investing in Kodak. But that's really where I got my interest in the stock market and investing, where hearing my grandfather's stories. And with some of the money that he saved, he bought me a computer when I was 13 years old, because this was in the early 80s and computers had just come on the scene, and I really loved them and thought that they were going to change the world. And after college, my father, who was a teacher, his friend was a teacher, had a connection on the floor of the Commodities Exchange in New York at the former World Trade Center. And that's where I got my start. Here's the clicker. All right. That's where I worked. That was the capital markets at the time. And I remember when I got down there, I asked the guy I worked for, what's my title? Because I just graduated from college. I figured I'd have a title. He said, title? You're the water boy's assistant. Go get to work. So that's where I first worked. And the first thing that I thought was, why aren't computers doing all of this? Why are people still screaming and with pieces of paper? But that was trading. And years later, I left the floor at the turn of the millennium, and with a few of my friends who were computer geeks like me, we started a company called GTS. GTS is an electronic market maker. We post offers to buy and sell financial instruments electronically using computers. So right now, most of the exchanges are completely automated, and we'll connect directly with those exchanges. And when investors trade, everything is done electronically and fully automated. Our mission at GTS is to do for the capital markets what Amazon has done for online commerce. Use technology in a responsible way to create efficiency and save investors money. We just thought, like everything else, trading would be more efficient, democratized using technology. And this is working. Today, GTS trades almost 5% of the US cash equity markets, and we do that in a completely automated fashion. It's about 1 out of every 20 shares that trade. And technology, overall, has been a very good thing for the capital markets. Most importantly, it's lowered costs for investors. When you invest, there's a bid and an offer for every security. The offer represents the price that you'll pay to buy something, and the bid represents the price that you can sell it from. Well, if the bid and the offer, the difference between the bid and the offer is very, very wide, over many years of investing, every time you trade or rebalance your portfolio, those costs are going to rack up. But with computers, the spread, the difference between the bid and the offer, has declined dramatically. This is a study that was done over the last 10 years, showing the difference between the bid and the offer spread. And as you can see, it's come down dramatically. And that's mainly because of computers. Before, when we were on the floor of the exchange, only the brokers and market makers on the floor could make a market. Whereas today, anybody who connects with a computer and has an exchange membership, et cetera, they can make a market. And computers, they can do things very, very quickly. So what ends up happening is that increased competition ends up bringing more liquidity to the market and narrowing those bid-ask spreads. Vanguard estimates that the shift from the old market structure to today's automated market has reduced costs by as much as 60% and delivered a 32% greater yield for long-term investors in less fees that they've had to pay. And many other folks, from academia to folks in our industry to regulators, have come out in favor of today's automated high-tech marketplace. Now, a few years ago, we thought that U.S. public companies, listed companies, could benefit from this technology, and certainly companies looking to do an IPO and go public. So we became a designated market maker at the New York Stock Exchange. This is a picture of our post down at the exchange. See, for hundreds of years, the market making was done in what was called open outcry, where brokers would come together representing customer orders, and they would scream out their bids and offers until a match was made. But as the markets became more electronic, the banks and brokers that traditionally did this service were replaced by much higher tech companies like GTS and some of our competitors. And now the entire floor of the exchange is all managed by electronic automated trading firms that look more like high-tech companies than traditional broker-dealers of the past. We thought we could do a better job using this technology. And now GTS is the largest designated market maker, responsible for over $12 trillion worth of market capitalization and some of the most important companies in the world. Now, as a DMM, we have a few very important responsibilities. The first one is the listed company depends on us to ensure that there's ample liquidity available in their company stock whenever investors need it. So 100% of the time during the trading day, we have to have stock available electronically for any investor who wants to buy it, and we have to buy stock from any investor who wants to sell it, regardless of what's happening in the market. Like during a volatile period, we still have to be there. And there are a lot of rules and regulations dictating quantitatively how much capital we need to have available to buy and sell in these securities. So that's the most important thing. We also need to provide critical content to these public companies, usually the CFO or the treasurer, sometimes the CEO or IR, about what's driving price discovery in their security. Because they have a lot of critical decisions to make. They have earnings conference calls where their investors demand to understand what's happening in their stock price. They have capital market things that they're doing, like maybe timing a stock buyback or foreign exchange or interest rate hedge, et cetera. The other thing we have to do is assist companies that are looking to do an IPO. And a private company looking to go public has to deal with the fact that the public has never been able to trade their stock yet. So there's a tremendous spike in demand that always happens right around that IPO. So we have to have the right technology there in place to aggregate all of that customer order flow and produce a fair market for everybody. But most importantly, these companies have asked us to help ensure that America stays #1 in capital markets and finance, and that the folks down in Washington and the rules and regulations that are put into place have their best interests in mind. So a few years ago, GTS and myself personally, we got more involved in talking to regulators and being down in Washington. This is last year we testified before the House Financial Services Committee on market structure, and learned an awful lot. And what I learned are two very important things that I want to talk about. The first thing, which I don't think is going to come as a big surprise, is that I was surprised for myself to see that things aren't always what they seem down in Washington. For example, sometimes politicians will say one thing that to help a certain situation, but it might insidiously be to the detriment of another. Last election, we kept hearing a slogan, make sure Wall Street pays their fair share. Perhaps as a reaction from the last recession. And there was a lot of talk about financial transaction taxes or taxes on trading or investing. And they were suggested to hurt Wall Street and to redistribute some of those tax revenues to pay for college tuition and other important social programs. But this financial transaction tax would really hurt saving for retirement more than it would hurt Wall Street. And think of it this way. When they put a tax on gasoline, it's not the gas station that pays the tax, right? The tax is passed on to the consumer. So if they taxed financial transactions, real simply, the bid-offer spread that we've worked so hard to narrow over these years is just going to widen to reflect that extra tax, whether you're selling or buying. And that's going to cost investors a lot of money. A recent study of public pension funds indicated that it could cost up to $1 billion every year from the financial transaction tax that was proposed prior to the last presidential election. And according to another study, an individual investor with a retirement account of $100,000 over a long period of time, 40 years, would incur approximately $42,000 in additional fees. Now, fortunately, this financial transaction tax didn't get approved and died after the election was done. But it's still lurking, and it's still being talked about. And it's just waiting for conditions in D.C. to be ripe for it, perhaps maybe during the next administration when the pendulum swings dramatically in the other direction. So we have to keep an eye on it. But unfortunately, there are already financial transaction taxes live, right under our noses. For example, every time there's a transaction in U.S. listed cash equity, a small, tiny fee is levied and goes to the Securities and Exchange Commission to fund their budget. Now, these fees, a lot of people call them a retirement tax because they impact long-term investors tremendously, but they're called Section 31 fees. And these fees were created decades ago, before the computer age. But now, with the modern market, they act as a retirement tax. Now, the SEC absolutely needs to fund their budget and the important work that they do. But this tax is being disproportionately levied on securities transactions, costing investors a lot of money, similar to a financial transaction tax would. But all of these things, as frustrating as they are, and unfair and costly, are actually small compared to a far larger problem. Right now, the average American is not able to invest fully in America. And what I mean by that is that we have fewer public companies today than at any time in the last 25 years. There are half the number of public companies today than there were a few decades ago. The pace of IPOs is 1/3 of what it was a few decades ago. Fewer and fewer companies are going public, and fewer companies want to stay public. And the companies that do go public are substantially larger than they were years ago. They're staying private longer. Great companies are being created and growing every day. It isn't that the economy isn't strong or there's some other problem, but all the growth and upside is being disintermediated and enjoyed by the private sector, be it private equity or other funding sources. And in some ways, that's a bigger tragedy because, and it's one that might help explain why it's harder and harder for some long-term retirement funds to generate returns good enough that maybe helped my mother through her retirement years, or created the investment opportunity like that my grandfather had with Kodak stock when Kodak was a much smaller company. Today, you don't see those investment opportunities until a lot of that great upside has already occurred. GTS had the honor of taking Snap public. Snap is a high-flying technology company that's changing the way people communicate. We took Snap public at a $25 billion market cap. Snap waited and waited to go public because they had all the private funding they needed, and going public was scary. And we hear a lot about other big growth companies like Uber, Airbnb. A lot of these companies, they're private. And when they go public, they're going to be public at that huge multiple. So a lot of investors never really got a shot at investing in them until a lot of that, a lot of the juice is already in there. When we ask these companies why they don't go public, they consistently say it's because of three things. First, the regulatory burden of being public is frightening. As soon as they're a public company, they can be frivolously sued, publicly or privately, by any management fault that occurs. It's also very, very expensive to go public. Companies call it the IPO tax. When you take a company public, you get charged by investment bankers 7%. 7% of the proceeds of the IPO. So if you raise $1 billion, you're going to pay $70 million. And the justification for this fee was that, and this has been like this for many decades, was, well, the bankers know where all the investors are. It's a very big country out there, and the bankers know where everybody is, and they're able to communicate and help sell and distribute. But you would think lots changed in the last 30 years. We have computers, information is completely democratized. That 7% fee hasn't changed. The other thing is the companies are pitched that they should IPO the stock at a slight discount to what their true value is. So, have a nice, healthy secondary market after, and have the stock rally after the stock goes public. And so the company's looking at crazy regulatory burdens, which only increased since the last recession. A lot of new regulations have gone live. Now they're trying to dilute some of them. And a lot of their net value being hit on IPO day. The third thing that they consistently tell us is that they feel like their interests aren't being taken care of in DC, that the system isn't protecting them. And keep in mind, financial transaction taxes, the retirement tax, these different fees, they don't have to pay that if they stay private. Their investors can buy and sell their shares, and they don't get hit with any of these transaction fees. But there's other rules. For example, last summer, we'll get into the weeds a little bit here, but one US stock exchange filed with the SEC to change the way public companies' market close occurs. Now, when you pull out the newspaper and you see where a stock closed, right? That there's a very specific process that governs how a stock closes, and it's a huge event in trading. It represents 7% of all the turnover happens on the close. And this one stock exchange operator thought, well, we could splinter and fracture that closing process and save Wall Street trading firms some money. Okay, so when they filed for this, I was genuinely a little excited because it would save GTS money when we traded on the close. But I still had to go talk to all of the companies that we serve as a designated market maker, and you know what? They were very much against it. And the reason why they were against it was, one of the reasons why they did an IPO in the first place is because they understood how the system worked. And the closing process is a very big deal because a lot of their stock compensation plans are based on the closing price. All derivative transactions are based on the closing price. It's the report card of the capital markets. So I felt it was important for me to fight that fight for them. So we went down to DC, we spoke with the regulators, we spoke with lawmakers, et cetera. We wrote op-eds, and the companies themselves wrote letters to the Securities and Exchange Commission, which is unprecedented. Normally, companies don't get involved in esoteric rules about stock trading. So you'd think with companies like Procter & Gamble writing letters to the SEC that they would be heard. Nope, the SEC approved it anyway. And we're fighting it, but it's on appeal. Let's see what happens. I just feel that if we're concerned about the lack of interest for companies going public, we shouldn't be enacting rules that make companies disenchanted with our markets. Because with less companies public, all that means is significantly less investment opportunities for retirement funds and more risk for a lot of those funds because you lose some of the diversification effects. What's even worse is the average tax-paying American is funding a lot of pro-growth initiatives and subsidies in this country that are allowing some of these businesses to grow in the first place. Yet, that same American doesn't get to reap a lot of the winnings of those sacrifices. So we need to ensure that every American can invest in our newest and most innovative companies and allowing Americans to invest in America. But there is some good news. There's light at the end of the tunnel. The new chair of the SEC, Jay Clayton, has taken up this issue directly, and the new SEC Commissioner, Robert Jackson Jr., spoke about this issue this past month in length. And also, I participated a few weeks ago at the SEC in an on-the-record roundtable about market structure, and this topic was front and center. So I'm cautiously optimistic that with some hard work, we can reverse this trend. And GTS has worked hard reaching beyond our shores to find investment opportunities in emerging markets, specifically China. This way, US investors can get access to that growth. And on this particular challenge, I won't be shy because GTS is #1 in IPOs over the last 4 years in Chinese mainland companies listing on the New York Stock Exchange. And here, the way we see it is we're exporting US corporate governance, among other things, to the Chinese market and giving US investors a shot at their appreciation. Look, there's no doubt that the US has the most advanced, deep, liquid, and well-functioning markets in the world. It's just important that our markets serve the true users of that system, from the companies who list, the pension funds who invest, and the retail customer. And GTS will work hard to do our part, from the technology we deploy to make the markets more efficient and fair, the service that we provide public companies, and the work we do to increase the investment opportunities for Americans. Because nothing makes me feel more excited than that IPO day, when GTS opens the stock for the first time, whether it's a company or an ETF. I know that with each public company we open, millions of investors are getting access to that American dream, like my grandfather did when he bought Kodak stock, and my mother's pension plan did when they managed her retirement. And I'd like to invite everyone in this room, if you're interested, to be our guest at an IPO. Please just reach out to me. There's my email, because everyone should have an opportunity to witness that important event. Thank you for having me at your conference. I really enjoyed being here, and thank you for all the work your organizations do for our communities. I think I have a few minutes. If anyone has some questions, I'm happy to answer. Okay, great. Thank you very much.